Imagine a typical morning in Toronto. The crowds are still rushing toward the Bay Street financial district, but something fundamental has shifted. There is no loud explosion, no Hollywood-style instant collapse. Instead, there is a haunting silence within the spreadsheets. Just 1%. A number that seems trivial, a mere statistical rounding error yet. Within Canada's hypersensitive economic engine, it is the opening shot of a grim scenario. When real GDP contracts by 1%, billions of dollars in market capitalization evaporate. From the TSX in just a few trading sessions. This isn't just a number. It is the start of a domino effect ripping through households burdened by massive mortgages. 1% is the razor-thin line between a soft landing and a free fall into a technical recession. Can a financial system touted as the world's most stable survive when investor confidence begins to fracture? We are facing a brutal test where every percentage point is no longer a goal, but the final life-buy, preventing a painful overhaul of the Canadian dream. The first signs don't appear on electronic tickers. They emerge in the consumer psyche of Vancouver and Toronto. As business confidence indices plummet, corporations freeze payrolls and suspend expansion plans, liquidity in the housing market there. Backbone of Canadian household wealth suddenly dries up. For sale signs stand ignored for weeks, while foreclosure filings at major lenders like RBC or TD begin to creep upward. In the bond market, Government of Canada yields fluctuate erratically, reflecting deep-seated fears of prolonged stagnation. Analysts scrutinize credit default swaps, CDS, as the cost of insuring Canada's sovereign debt spikes. The global financial elite begins to doubt the Maple Leafs' resilience. A 1% slowdown is more than a production shortfall. It is a structural crack in a system overly reliant on foreign capital and cheap, borrowed money. The mechanics of this shock follow a ruthless logic, the asset deflation spiral. As GDP slows by 1%, federal tax revenues drop instantly, forcing Ottawa into a corner. Cut spending or borrow at higher interest rates. This exerts downward pressure on the Canadian dollar CAD, eroding international purchasing power and driving up the cost of imported essentials. Interest rates, held high to fight inflation, now become a double-edged sword, shredding the profit margins of small and medium-sized enterprises. As cash flow constricts, banks tighten credit conditions to protect their balance sheets, inadvertently pushing borrowers into situations where they cannot refinance. This is a combined supply-demand shock. Citizens fear spending due to job insecurity, while businesses fear investing due to lack of customers. The velocity of money hits record lows, turning the economy into a stagnant pond where inertia feeds panic. Global history is littered with similar scripts where 1% was the tipping point for systemic failure. Look back at the 1997 Asian financial crisis, where a loss of confidence in exchange rates wiped out decades of growth in months. Consider Greece, where slowing growth combined with massive public debt led to a lost decade of IMF-imposed austerity. Even in Argentina or Turkey, slow responses to minor shifts in capital flows led to hyperinflation and the collapse of the middle class. While Canada boasts a sturdier banking system, it also holds one of the highest household debt-to-GDP ratios in the G7. This makes us as fragile as a skyscraper built on fine sand. A 1% gust of wind can trigger tremors that less indebted nations would simply ignore. For Canada's domestic economy, this slowdown feels like localized cardiac arrest. The oil patches of Alberta, sensitive to global energy demand, are the first to see large-scale layoffs. In Ontario, manufacturing and processing sectors face bloated inventories as demand from south of the border cools. However, the deepest wound is in real estate. With a 1% GDP drop, the unemployment rate typically rises by 0.5% to 1%, meaning hundreds of thousands of Canadians lose the ability to service their mortgages or LOCs. As forced liquidations hit the market, home prices could slide by 20 to 30%, evaporating trillions in net worth. The phantom wealth built on property values vanishes, dragging down the service, retail, and construction sectors, the very pillars currently propping up the Canadian way of life. The response from Ottawa and the Bank of Canada BOC will be a high-stakes psychological war. Traditionally, the BOC would cut rates to stimulate growth. But if inflation remains stubborn, cutting too early would debase the loonie, send the price of essentials skyrocketing, and trigger a flight of foreign capital. The government might roll out massive stimulus packages, but with current debt levels, every dollar spent is a burden placed on future generations. We might see tighter capital controls or direct intervention in the housing market to prevent a systemic meltdown. However, lessons from Venezuela or Turkey show that once economic fundamentals are broken, administrative band-aids cannot stop the bleeding of a severed artery. Institutional credibility is the only asset left, and it is the easiest to lose. At the individual level, a 1% GDP contraction translates directly into instability at the dinner table. The middle class, long proud of their stability, suddenly realizes they are exactly 3 months of lost income away from insolvency. Stories of families cutting private health insurance, trading luxury SUVs for public transit, or delaying their children's education become commonplace. The labor market turns cutthroat. A single management position might see thousands of applicants, including overqualified professionals willing to take minimum wage just for a paycheck. This is the moment job security becomes a luxury. The wealth gap widens. While the elite take shelter in gold or hard currencies, the average worker is trapped in a shrinking economy with a devaluing currency. To survive this storm, a defensive financial strategy is mandatory. Practical insights from previous crises prove cash is king, but liquidity is God. Individuals must prioritize wiping out variable debt before credit markets freeze entirely. Diversifying investment portfolios outside of Canadian borders holding defensive assets, like gold or US-based index funds ETFs, is a way to preserve purchasing power. Simultaneously, investing in human capital skills that cannot be replaced by AI or hindered by geography will be the passport through periods of corporate downsizing. Do not look at your current salary. Look at the liquidity of the assets you hold. In a 1% slowdown, the winner is not the one who earns the most, but the one who is least vulnerable when the system hits the pause button. Looking deeper, this 1% slowdown is a warning about a growth model overly reliant on consumption and debt. Canada has for too long pumped money into real estate and imported human capital while neglecting actual labor productivity. This shock, though painful, is a necessary correction to bring the economy back to reality. It forces policymakers to rethink the national strategy. Do we remain a wealthy nation built on phantom asset values, or do we transform into a true innovation powerhouse? Nations that survive recessions are those brave enough to face the harsh truths of past mistakes. 1% might be the start of a crisis, but it can also be the seed of a sustainable restructuring, where prosperity is built on real value rather than ephemeral credit numbers. We have explored the scenario of a seemingly small decline that carries the force of a tectonic shift. From the soulless numbers on Bay Street tickers to the anxiety etched on the faces of everyday Canadians. 1% is more than an economic indicator. It is a mirror reflecting the fragility of a global financial system riddled with tangled connections. As the lights in Toronto's skyscrapers dim after a volatile trading day, the question of the future remains hovering and defiant. Economics is not just mathematical modeling. It is the science of choice and trust. After all the talk of interest, rates, exchange rates, and public debt, one truth remains. An economy is only as strong as the trust between its people and the system. So, if the data tomorrow truly shows a 1% drop, are you ready for a world where the old rules no longer apply? Or, more importantly, does Canada have the courage to change before that 1% becomes an irreversible destiny?